Welcome, everyone, to the Gold Talk Show, right here on YouTube.
Great to be here.
If you're someone who wants to get past the headlines, really understand what's driving gold prices, well, you've come to the right place.
Exactly. We're going beyond the day-to-day noise today.
We are doing a deep dive. We're looking at this recent, pretty powerful surge in gold. I mean, breaking $2,300 and fast.
Yeah, surprisingly fast. So the big question is, what's really behind it?
That's what we want to unpack. We've been looking at some really interesting analysis, some insights from someone who seems to have a good handle on the financial world. And the core question is this: is this rapid gold climb? Is it just a sign of, economic jitters?
Or is there something more deliberate happening? Maybe a calculated move by some major financial powers pulling strings behind the scenes.
Exactly. So let's start with that puzzle. Gold shoots up to $2,300. A lot of smaller investors, maybe people like you listening, are suddenly feeling hesitant, right? Like, did I miss the boat? Is it too late to jump in?
It definitely creates that feeling. And, when you see a move like that, your first thought is, okay, is this just a normal reaction? Economic worries. Yeah, inflation.
But is it? Traditional supply and demand?
Yeah.
Well, it doesn't quite seem to explain the speed of this rise, does it?
Not fully, no. It feels like there are other forces at play. The material we're looking at really points towards market psychology, how information gets spread.
And crucially, these strategic moves by the really big players, central banks,
Yeah.
huge financial institutions, their actions seem to carry enormous weight.
Precisely. And here's where it gets really fascinating and maybe a bit counterintuitive. You've got these large gold ETFs, exchange-traded funds. They hold massive amounts of gold.
Okay.
They've actually been selling off gold on balance, net seller.
Selling. Huh.
Huh.
So what does that suggest? Maybe shorter-term investors cashing out. Doubts about the rally continuing.
Could be. It might signal less conviction from some of those larger, perhaps more momentum-driven funds. But, and this is the key contrast,
There's a but.
there's a but. At the very same time, you have central banks, think China, India, Turkey, Russia. They seem to be doing the opposite. Quietly, consistently, buying, adding to their reserves.
Almost under the radar, you're saying.
Exactly. And if
No.
you put those two things side by side, the implications are pretty significant, aren't they?
Yeah, it's a real divergence. ETF selling suggests maybe short-term thinking, profit-taking. But central bank buying, that sounds more long-term, more strategic.
It hints at something potentially political even. They're looking way beyond next week's price action. It feels like a bigger picture play.
China's often mentioned in this context.
Yeah.
There's this persistent speculation, right, that their official gold holdings, well, they don't tell the whole story.
Not by a long shot, potentially. The suspicion is they've been accumulating steadily, maybe through channels that aren't fully public, and their actual stash could be much larger than what's reported, like a hidden war chest.
And why be so discreet about it? If it's just normal reserve management, why this secrecy? Why this sustained buying quarter after quarter?
That's the million-dollar question, or maybe the multi-billion-dollar question. Russia's case is maybe a bit clearer, more directly tied to current events.
Sanctions, right.
Exactly.
Correct.
Facing financial sanctions, freezing of assets, gold becomes a way to insulate themselves. It's a hedge against having their U.S. dollar or euro assets blocked or seized.
Makes sense. It's an asset outside that Western-controlled system.
Yeah.
And it's not just China and Russia.
No, the analysis points to Turkey and India as well, being part of this quiet accumulation trend.
So again, if this was just your standard flight to safety because the economy looks shaky, you wouldn't necessarily expect this level of quiet, coordinated, long-term buying from multiple major nations.
Precisely. And add another layer, the timing. While this central bank buying has been ramping up, what else have we seen?
A lot of gloomy headlines.
You got it. More talk about recession risks, worries about bubbles, especially in U.S. corporate debt, geopolitical hotspots flaring up in the Middle East.
The ongoing U.S.-China trade tensions. It all adds up.
It creates this climate of fear, doesn't it? An atmosphere of unease. And the idea presented is that this fear naturally pushes the public, the average person, towards gold as that traditional safe haven.
Which maybe conveniently aligns with the goals of those bigger players who are already buying.
It certainly makes you wonder. This highlights a critical concept, information asymmetry. Whoever has the information first or controls its release, they have a huge advantage in shaping how the market reacts.
Yeah, the average investor is reacting to the news, but someone else might be making the news, or at least timing its release.
Exactly, which is why you need to be skeptical when you see those really bold price predictions. Gold to $2,500.
Right. The material we looked at specifically warns against just blindly buying into those targets. It forces you to ask, okay, who actually benefits if I believe gold is going to soar like that?
It could be someone who bought much lower and is looking for exit liquidity. Or maybe it's part of a larger strategy to prop up the perceived value of gold, making it harder for dollar-dependent nations, perhaps?
So gold is moving beyond just being a commodity or even just a simple safe haven. It's becoming, what, a strategic piece on the global chessboard.
That's a good way to put it. A strategic asset in the global currency game. A counterweight, maybe, to the dominance of the US dollar.
And sudden price spikes might not just be market panic, they could be deliberate pokes, calculated moves to put pressure on the existing financial system.
That's the suggestion, which means for us, for you listening, we need to be really careful about how we interpret market moves and news. Don't get easily swept away.
Because it could be part of a bigger, more complex setup, a trap even.
So if you're investing for the medium or long term, the key question is, are your decisions driven by solid data, your own research, your own goals? Or are you maybe getting nudged by this broader, possibly manipulated sentiment?
And if you're a short-term trader, well, that's a whole different game. You really need to understand who you're trading against, who's really calling the shots.
Absolutely critical.
Okay, this leads us naturally to this next fascinating area, the idea of a battleground. Wall Street versus the BRICS nations. This sounds like a clash of titans playing out in the gold market.
It does. And one piece of evidence pointed out is these sudden, sharp, sometimes really hard to explain price drops or surges that often happen right around the market open in London or New York.
Yeah, those moments where the price just tanks or rockets for seemingly no reason.
Exactly. No major news event, nothing obvious, but bam, a huge move. The perspective here is that this isn't just random noise or typical investor activity. It's a sign of this silent geopolitical struggle influencing gold prices.
So below the surface of everyday trading, there's this financial conflict happening.
That's the picture being painted, a confrontation between the established Western financial system, symbolized by Wall Street, and these emerging powers, particularly the BRICS countries who want to reshape things.
So how does Wall Street exert its influence in this scenario? They have the big institutions, the technology.
Precisely. Massive financial institutions, armed with incredibly fast, high-frequency trading HFT algorithms, they can execute huge orders in milliseconds.
Creating instant price shocks.
Yeah, shockwaves that can trigger reactions from retail investors globally. Stop-loss orders get hit, people panic sell or buy.
And the really crucial point, maybe the worrying one, is that these big players are often set up to profit regardless of which way the price moves.
That's often the case. Because they control so much of the order flow, they have superior information, they can potentially scalp profits from the volatility they themselves might help create. They can play both sides.
Okay, so that's the Wall Street side. Now the BRICS nations, Brazil, Russia, India, China, South Africa, though the focus seems mainly on China and Russia here, they're positioned as the counterforce.
Right. And it's not just about buying gold. It's part of a much bigger, more comprehensive strategy. Gold is a key pillar in their efforts towards de-dollarization.
Reducing reliance on the U.S. dollar for international trade and reserves.
Exactly. And things like U.S. sanctions, the way the dollar system can be used politically, that's really pushing these countries to find alternatives.
And gold is seen as neutral, right? Not controlled by any single country's political agenda.
That's its appeal. It becomes a tool for protecting national wealth, a non-political financial instrument.
And China's accumulation comes up again, the idea they hold much more than they officially admit, maybe buying through non-transparent means.
And Russia provides a very clear example. After their dollar and euro assets were frozen, what did they do? They pivoted, started buying gold produced domestically, even using gold for payments with partners outside the West.
So gold is becoming more than just reserves sitting in a vault. It's potentially a medium of exchange, again, a tool for financial sovereignty.
That's the shift, which means the game of manipulating gold prices, if that's what's happening, it's not just Wall Street's playground anymore.
Because the BRICS are actively playing too with their buying.
Yes. Their coordinated large-scale buying directly clashes with Western interests that might prefer to keep the dollar dominant and maybe suppress gold's role. So the gold market becomes this sort of underground battlefield.
Where price shocks aren't just market jitters, they could be tactical maneuvers in this bigger conflict.
That's the suggestion. Maybe designed to exert political pressure or disrupt the asset allocation plans of opposing nations. It's not necessarily about serving the average investor.
Which leaves individual investors even smart ones, potentially caught in the crossfire, used, maybe unintentionally, to amplify these effects.
It's a definite risk. And the analysis also brings up the lack of full transparency in gold pricing ever since the gold standard ended back in 71, plus the financialization derivatives, short selling adds layers of complexity.
And there's this contrast in how the West and the BRICS view gold.
Seems so. For many Western financial players, it might be seen more as a leveraged asset, something to trade for profit. For BRICS nations, it looks more like a fundamental building block for financial independence.
So they care more about the amount of physical gold they hold, the actual tons, rather than just the day-to-day price fluctuations.
That appears to be the priority: quantity and direct control.
Which brings us back to that core question. Are today's gold prices just supply and demand? Or are they the result of this silent battle between two financial world orders?
And the likely outlook. As long as the dollar is used as a geopolitical tool, these opposing nations will probably keep elevating gold's role as that counterweight, making gold's price movements mean much more than just economics.
It's a really compelling, if slightly unsettling, picture. Okay, let's shift gears a bit and talk about something many investors can probably relate to. FOMO, fear of missing out, and these pumping tactics.
Ah, yes, FOMO. That sinking feeling when you buy gold right at the peak of excitement, maybe after seeing everyone else talking about it, only to watch the price tumble. Regret, frustration.
We've all felt something like that.
Yeah.
And the idea here is this isn't always just bad luck. It can actually be a deliberately set psychological trap.
That's the argument. You really have to ask, who starts these waves of hype? Who controls the narrative, the news flow, and ultimately who cashes in when the herd rushes in?
Because gold, traditionally, it's seen as defensive,
Right.
stable. But it sounds like it's being used more and more for short-term speculation.
And that creates opportunities. Big players, market makers, influential figures, maybe even media outlets can potentially exploit the impatience, maybe the lack of deep knowledge, and the desire for quick profits among smaller investors.
The pattern described sounds very familiar. You see some technical analysis charts looking bullish popping up on social media.
Then come the headlines. Gold breaks out. Next, stop $2,500. Then online groups, maybe Telegram or Facebook, start buzzing.
And boom, FOMO kicks in. People see the price moving up, they hear the hype, they're terrified of missing the rocket ship.
So they rush in to buy. And what does that surge of buying demand provide?
An opportunity for the whales, the big holders, to sell.
Exactly. They can unload their positions at those high prices, often triggering automatic sell orders as the price starts to wobble and causing that sharp reversal that leaves the FOMO crowd holding the bag.
So who creates this FOMO wave? The analysis points to those who control both the information flow and the market liquidity.
Right. Think large institutions potentially working with financial news platforms, maybe even paying to promote certain narratives where entering a gold supercycle or inflation is back, you need gold.
And these narratives, they might not be entirely false, but the timing and the intensity are key.
Yeah.
They seem to get loudest just before the market might be about to turn.
And there's another potential sting for FOMO buyers: the difference between the spot price of gold and the price of actual physical gold, especially in some local markets. Vietnam was mentioned as an example where this premium can be huge.
So you're buying at the peak and paying extra on top of that makes it almost impossible to get out without a loss if the price corrects.
It's described as a potential double profit for those orchestrating the wave. They profit from the price spread on physical gold, and they offload their holdings at inflated spot prices.
And it's not just novice investors who fall for this. Even experienced ones can get caught up.
Oh, absolutely. Social proof is powerful. Seeing others supposedly making easy money, it's hard to resist. Plus, people rarely advertise their losses, only their wins.
And the observation that the strongest, sharpest rallies often happen right before a significant correction.
It makes sense. If you're holding a huge amount of gold and you want to sell it without crashing the price, you need to create a very compelling story about why it's going even higher. You need buyers.
So it's about managing belief, directing the narrative, not necessarily lying, but shaping perception.
Precisely. So the takeaway here is really to reflect on your own reasons for buying gold. Was it a calm, rational decision based on your own analysis? Or was it driven by that fear of missing out, by the crowd's excitement?
Recognizing that pattern can help you realize that not every wave is meant for you to ride. Some are designed for others to cash out on. Okay, this leads to a really fundamental question then. Is gold really the ultimate safe haven we think it is? Or is that perception itself being used, maybe manipulated?
It challenges a core belief, doesn't it? Gold equals safety. But the information we're digging into suggests this belief, this instinct, might be cleverly exploited.
The argument isn't that gold isn't safe, but that the idea of safety itself can be a tool to steer money, manage emotions.
Exactly. In modern finance, gold becomes this kind of psychological lever. Pulled by those who control information, liquidity, and the media narrative, it taps into primal instincts.
And we see this play out, right? Stock market drops, crypto crashes. Suddenly, what's in the news? Gold prices are up. Gold is resilient.
It provides that psychological life raft. It stops a total panic, prevents everyone from just pulling all their money out of the financial system entirely.
And this narrative isn't accidental. It's built through trading patterns, news reports, analyst commentary, social media buzz. It's like a carefully staged drama playing on fear.
Think about it. Crypto tanks, NASDAQ Q falls hard. Next day, headlines everywhere. Gold hits 12-month high. Experts see further gains. What happens? Money flows out of the risky stuff and into gold.
But who really wins in that scenario? Is it the person fleeing crypto who buys gold at the new high? Or is it the market makers, the early birds, maybe even governments wanting to temporarily stabilize things?
It raises the question, are you finding a true safe haven, or are you just being parked at a high price until the storm passes, caught in that expectation trap, hoping it goes even higher?
The COVID-19 example from 2020 is brought up. Gold surged, hailed as the ultimate safety play.
But then, governments rolled out massive stimulus, stock markets roared back, and gold, well, it fell sharply, leaving those who bought at the peak with significant losses.
So the safe haven role can be switched on
Mm-hmm.
and then switched off again once it's served its purpose of calming nerves or redirecting capital.
That's the hidden side of safety in this modern financial game. Information is a weapon, emotions are the target, and gold is sometimes the tool used to build temporary trust, like a rest stop to keep people in the system.
It really forces you to ask, are my moves being anticipated in a larger game? And why is it always gold that gets pushed first when things get shaky? Not real estate, not oil, not defensive stocks.
The suggestion is it's gold's unique symbolism, its ancient connection to wealth, survival, its perception as being outside the system. That makes it uniquely powerful and uniquely exploitable as a tool for controlling belief.
So if you're buying gold purely for risk avoidance, the advice is pause. Ask yourself, what risk am I really avoiding? And who's making me feel this need to avoid it right now? Am I reacting to a signal?
Because if emotions are controlled, the market is easier to manage. Shifting funds into something relatively stable like gold gives the big players breathing room to execute their next moves without causing a system meltdown.
And the danger is, you don't see the controller. You don't know when they'll flip the switch on the safe haven narrative. You're just looking at charts, news, and gut feelings based on possibly manipulated emotions.
So it's not denying gold's value, but its true safety comes from understanding why you hold it and its place in the bigger picture. Hold it because you understand, not just because you are made to feel you should.
Which brings us to this final, really mind-bending point. Gold, this ancient physical asset in our hyper-digital age. Why are central banks secretly hoarding it on a scale not seen in 50 years? Is it hiding something bigger?
It is a bit jarring, isn't it? We're all talking blockchain, crypto, stablecoins, CBDCs, AI in finance, everything's going digital. Yet, quietly, central banks are making the biggest push into physical gold in decades.
So the question is, what role is this seemingly old-fashioned metal playing now? Is it just diversification, or is it, as suggested, a silent shield, a hedge against potential deep instability in the fiat system that most people aren't seeing?
Yeah, the world focuses on the flashing numbers on screens, the virtual assets. But maybe gold's primal tangible nature is seen as the ultimate backstop if things go really wrong. A hedge against a crisis, or a fundamental change in the rules of the game.
And the analysis stresses it's not retail investors driving this. The media talks about gold as a safe haven for you, the individual, but the massive buying is governments.
Hundreds and hundreds of tons net buying by central banks, China, Russia, Poland, Turkey, Singapore, others, just in the last couple of years. More than during the 2008 crisis, more than during COVID.
And they're not shouting about it.
Yeah.
No big press conferences, no policy statements saying, we're going back to gold. It's just this silent, systematic, relentless accumulation.
The argument presented is, this isn't just defense, this is like preparing for something potentially huge brewing behind the glossy economic growth charts.
You have to think, people managing trillions in national assets, they don't make moves like this lightly. They must have a very strong reason. What are they defending against?
Well, the analysis points to potential breaking points in the current system. the way the US dollar has been weaponized through sanctions,
Using the SWIFT payment system as a political control tool.
the general erosion of faith in fiat currencies after all the money printing, especially post-pandemic. Could the system itself be nearing a point of extreme stress?
And in that scenario, gold becomes the ultimate anchor. Not for profit, but just as a bedrock store value if trust in everything else collapses.
Exactly. In that role, gold doesn't need to do anything. It just needs to be there, locked away. A financial insurance policy nations hope they never cash in.
And how does this sit with crypto, CBDCs, de-dollarization? It seems contradictory, pushing digital currencies while hoarding physical metal.
The suggestion is maybe even the architects of the new digital systems realize that during a major transition of power or trust, you might need a solid physical anchor to reboot confidence if things go sideways.
Because gold has those unique properties. Can't be printed, can't be deleted by code, isn't controlled by one country or one system.
So, is the gold accumulation a kind of smokescreen, hiding preparations for a major global financial overhaul? A reset where the rules of money issuance, circulation, control might fundamentally change.
And in that new game, if you don't have significant gold reserves, you lack negotiating power. Physical assets might get revalued under entirely new rules.
It makes you look at things like the U.S. debt ceiling debates, Europe's inflation struggles, China pushing the RMB for global trade. Are these all tremors before a bigger earthquake? Is gold being positioned as the stable element to manage the chaos while the system gets reprogrammed?
And the final provocative question: who wins in that kind of reset? Those holding the physical gold, or those heavily invested in digital assets whose long-term value is still uncertain?
It's a powerful thought. And the closing observation is that preparations for truly major crises, they happen quietly. Those who understand the deep currents, they don't broadcast their moves. They just accumulate gold, shift away from U.S. bonds, diversify reserves, build more independent financial pathways, getting ready while the rest of the world watches the surface.
Wow. Definitely gives you a lot to think about, way beyond the daily price ticks. Thank you so much for joining us today on the Gold Talk Show for this really, really deep dive.
My pleasure. It's crucial to look beneath the surface sometimes, isn't it? To consider these bigger forces at play.
Absolutely. And if you, listening right now, found this deep dive valuable, if you want to stay ahead of the curve with the latest insights and analysis on gold,
And do us a favor.
please hit that like button, share this video with anyone else who might be interested in this perspective, and most importantly, subscribe to the Gold Talk Show channel right here on YouTube.
We'll keep digging into these important topics.
We certainly will. Thanks again for tuning in, and we'll see you next time for another in-depth discussion.